Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm good, Bryce. Very excited for this episode. We are going to be talking to an expert today who I would say straddles two of the hottest sectors in Australia.
Private credit.
So, let me ask you. If I was to say, what are the hottest sectors? Private credit.
Private credit and, of course, Aussie property.
Yeah. And I think if we were to drill down further, I would say on the institutional investor side, private credit captures share of voice, share of wallet.
Definitely.
And then on the everyday investor, everyday Australian side, Australian property is still front of mind.
Big time.
And so when we came across a company that straddled both asset classes and has straddled both asset classes for over a decade, we were interested to learn more.
So today we are joined by Mark Fischer, who is the co-founder of Qualitas and the global head of real estate at Qualitas. They are a listed company. The ticker is QAL, listed on the ASX. And when we were researching for this interview, we found some pretty interesting insights from the Qualitas team around the Australian real estate market. In particular, that residential housing market needs to go backwards or it's going to get worse before it gets better.
Yeah, that is not news that we want to hear. And I think when we were thinking about that, it illustrates one of the contradictions in Australian housing. Everyday Australians want affordable housing.
Yeah.
And to get affordable housing, it asks for greater supply. That's one way to get there. Greater supply requires investment to build, but capital flows to where it can get the highest return, which asks for higher prices. And that's the inherent contradiction in Australian housing at the moment, and kind of what Mark and the team were getting towards, which is that for it to get worse, for it to get better, meaning prices need to go higher to attract more capital, to increase supply, to hopefully reduce prices.
Yeah.
Which is not news that anyone wants to hear.
No, it's challenging. So as we get into the conversation with Mark today, we were interested in his unique perspective as someone who's sitting behind both of those capital flows. Where does he see investment moving and how the increased interest in private credit is changing the direction and velocity of these flows? Yeah.
Now, before we get into it, we do want to say a massive thank you to Qualitas for supporting this episode. Their support helps us keep this episode and all of our content free across Equity Mates. So, Bryce, I think let's get into it.
Let's do it. Well, Mark, it's great to have you. Welcome to Equity Mates.
Thanks for having me on the podcast, and great to be here, at least virtually. I've listened to a number of your shows, and I have to say congratulations on an amazing format and some amazing guests that you've had on as well.
Oh, we really appreciate it. It's people like yourselves coming on and contributing your time that have certainly helped us to get to where we are. So we do appreciate all the experts like yourself coming on.
Of course.
So let's start with an introduction to yourself and to Qualitas. For those unfamiliar, can you introduce us to Qualitas?
Qualitas is a leading what we call alternative real estate investment manager, and the firm is listed on the Australian Stock Exchange. And together with my co-founder, Andrew Schwartz, we've been on an amazing journey since 2008 and now have approximately $9 billion of funds under management in the business. So for the last 16 or so years, we've been investing in what we think are attractive risk-adjusted returns for our investors in two things: a real estate private credit strategy and then a real estate private equity strategy. And really what we're doing is help our borrowers and partners realise their vision for their real estate assets.
So we want to unpack a little bit more about the alternative real estate investments that you guys are making and understand that. But we want to start with the founding of the business, because you mentioned it there. You co-founded Qualitas in late 2008. Not a great time to start a real estate investing business, I imagine.
Maybe.
Yeah. So what was it like right in the teeth of the GFC? What were those conversations with investors like? And just what was it like in the real estate investment market at that time?
Yeah, it's funny you say that it's not a great time to start a business. Our view certainly was, in that environment of the GFC, was an excellent time to start a business like what Qualitas does, because what you see in that environment is a tightening of liquidity into real estate markets. So everyone pulls back, becomes suddenly conservative, and liquidity, money, availability of money evaporates from the system. And that, in our view, is the ideal conditions to start a firm that provides an alternative form of capital. So really the genesis of the business was seeing that happen around us and knowing that that creates opportunity. And then investing in the business, really we started with what we were doing in our prior lives. And I think it's the DNA of the firm, and certainly the early years of the business was as real estate equity investors. And in those early days, our focus was on the higher risk, higher return end of the spectrum, very structured equity investments into real estate projects and assets. And this was really an amazing period for us. We generated significant returns for investors, but the intent always of Andrew and I from the day we started the firm was to build an enduring investment management platform. And we wanted to be dominant in the field we chose to go into. We weren't interested in being an also-ran in that. We wanted to be really a leader in what we did. And so after a few years of the business, we identified that there was this emerging trend globally around private credit. It was a fundamental shift in the way capital markets were working in real estate. One of the things we always did was keep in touch with our peers globally. Our networks are such that we know people in North America and Europe who do very similar things to what we do. And we started to see where they were focusing their attention, and it was in credit investing, so making loans to real estate owners. We picked up as well that there were some interesting structural drivers happening in that space. And so we started to pivot the business quite heavily towards credit investing. And really the story around Australian real estate private credit has only grown from there. The banks are no longer able to participate like they once did in the lending market. And that's given a great opportunity for alternative sources of capital, such as Qualitas, to really fill that gap and give some flexible financing to borrowers. When that started to happen over the last 10 years in particular, it's become mainstream. So what used to only be available to very sophisticated institutional investors in our funds has now been able to be made available to retail investors, high net worth investors, but also more recently in a listed environment as well.
Interesting. So Mark, can you, with those sort of like asset classes in mind, can you help us understand your investment philosophy when it comes to assessing an opportunity, be it in real estate itself or those like alternative opportunities that you mentioned?
Yeah, so we are what we call sector agnostic. So that means we invest across all of the major commercial real estate sectors. So that includes residential, industrial, office, and retail. And we do this both by way of equity investments as an owner of real estate, but also by way of credit investments, making loans to other people who own the real estate. But the nuance perhaps is we do this by way of private markets. These are directly negotiated loans between ourselves and borrowers, or they're privately held real estate within fund vehicles that we manage. This is as opposed to investing in public market equities or a REIT type structure, or in fact bonds that are backed by real estate that are tradable. And as I sit here today, the circa $9 billion of funds under management in the business, around 80% of that also is in the credit strategies, and about 20% of that is in our equity strategy. So that gives you a sense of how it's developed over time. If you think back to the DNA of the firm being an equity investor, and now today 80% of what we do is credit, I think that points to the real growth in that sector. But it's also partly about the cycle as well. The cycle's been very conducive to growing a credit business. But maybe if I just explain for the audience as well the differences between what I mean when I say a credit strategy and an equity strategy. And I think all businesses, and real estate is no different, have a capital structure. And really what we mean by that is the hierarchy of different types of financing used to fund a business or fund a real estate asset. And we call this the capital stack. In real estate, what it refers to is the order of claims on the income from the property or the asset value from the property. And each layer in that represents a different risk-return spectrum. The first to be repaid is the senior debt, and then it's what is called mezzanine debt. These are our private credit strategies. Sometimes it has preferred equity, and then, of course, the ordinary equity, which is last to receive its profits and distributions. So we invest across that capital stack, and we offer a range of fund products to investors that allows them to choose, depending on their risk-return appetite, where they like to play.
So let's hold on the private credit side, because I feel like that's the asset class in Australia that is just capturing headlines and capturing investor attention at the moment. And private credit as an asset class spans far more than just real estate. So if we drill in on real estate private credit, can you tell us a little bit about how that asset class looks, the returns, the volatility, correlation, perhaps to some of the other key categories of private credit that are emerging as well?
Yeah, no, great question. It's something that you can track in a sense to what you see in other markets. And I think the sector in Australia is significantly less evolved than you see in the United States or Europe and the UK. And I think in Australia, it's a multi-decade growth runway ahead of us on this. So really what is driving it globally is the way in which banks are regulated. The prudential regulators have made determinations around banks have to hold capital to fund their assets. And what that's doing is their amount of equity on the bank balance sheet allocated towards making a loan is continually increasing, and therefore their cost of capital from a bank perspective is increasing as well. And what that means in effect now is that a lot of corporate loans and a lot of real estate loans are increasingly difficult for the banks to hold on their balance sheet. That's important because what it means is this is not a point of the cycle. This is not people taking undue risk when the banks don't want to take it. It is driven by regulation, and we can't see that changing anytime soon. So what does it mean when you start investing in that? Bond Advisor have published some analysis that shows that the commercial real estate private credit sector on an average basis over 5 years returned around 8%. And that typically is done with a lower volatility compared to other investment types. And I think when you look at the returns that come out of a public equities portfolio over a long run period, that's a very compelling return to be delivering with downside protection of being a credit investor as well. But one thing that we think is perhaps misunderstood when it comes to real estate credit in particular is that there are different types of strategies. We have what we call a risk-on strategy that delivers higher total returns but with more risk. For any investors looking at the sector and trying to understand where they might want to invest personally in it, there is a risk-return trade-off. Nothing is free in what we do, and we're starting to see now some of the newer players suffering from some of the loans they made where they thought they were earning outsized returns, but really what was happening was they were taking a bit more risk. So if you do it in a considered way and think about risk management as a core part of what we do think private credit is a through-cycle asset class for investors.
Well, Mark, we want to do a bit of a deep dive on the residential property sector because you guys have that's where you kind of have a focus, particularly in providing credit to the apartment construction market.
Sure.
So just to give us a sense of where we're at, how do you think about the current state, or how do you assess the current state of Australian residential property?
Yeah, I mean, I'll start with one of my golden rules for real estate investing as well. And I particularly like it because it's quite simple and it's something we talk about all the time amongst the team. And it's really three core things that are all linked together. Firstly, is the property relevant and desirable to that end user, be it the tenant or the buyer? Is the price that they need to pay, either as rent or purchasing it, correct? And is there enough depth of customer who might want to live in or occupy that piece of real estate? And if you draw everything back to that, we think it's an amazing starting point to think about real estate, whether it's as a credit strategy or an equity strategy. So if I take that as our golden rules and then apply it to the residential sector, it's something that's been a long-term strategic priority for the firm, particularly financing apartment buildings, because it's one of the biggest dislocations in those golden rules that we've ever seen. We've got deep expertise in the sector, which is helpful, but the fundamental drivers are really good. The population-driven demand for housing and the continual, what we call densification of our cities, so more medium and high-density housing being built, are great drivers for the demand side. But perhaps more interestingly is there's been a significant withdrawal of liquidity. There's limited credible parties with capital who can make big loans into the space, and we're fortunate to be one of the few. What we think is out until 2028, over the next few years, there's probably a demand driver of about 300,000 apartments that need to be constructed in the country. And if you want to put a dollar figure on that, because I think it helps bring it to life a little bit, we think that's somewhere between 200 billion to 250 billion worth of financing that needs to happen to build that out. So lots of demand, satisfies the simple golden rules of real estate, but not enough capital in the system. And we think that's a really compelling environment to invest in, and we don't see it changing anytime soon. It's actually very rare in our experience, having a sector that's got really robust real estate fundamentals, but a shortage of liquidity doesn't happen. Normally, when it's really good from a fundamentals perspective, there's a lot of money chasing that strategy, and that ends up driving returns down. But that's not the case currently in residential in Australia.
It's not a surprising story that the housing market sort of isn't in equilibrium. You would have expected that there would be a supply side response, that the financing would materialise to meet the sort of need of the moment. But to your point, it seems that it hasn't. What are some of the impediments to other people doing what you're doing and trying to play in this space?
Yeah, I mean, the supply side response is the right response to this issue. You see, and this is a global phenomenon, governments flirting from time to time about tinkering with the demand side response, things like stemming the flow of migration and so on. We don't think that's the solution, and it is a supply side response to fix issues like this. But the thing about real estate and introducing supply is it takes many, many years to do it. The typical project needs to get planning permissions in order to be built, and that involves usually not only local council, but state governments and many layers of expert reports and approval authorities in order to get the authority to construct your building. That, in an ordinary case, takes a few years to get that in place. But then you also have to build the building, and that can take anywhere from 2 to 4 years, depending on the scale of the building. So what that means is it's incredibly hard to get supply to respond to this situation quickly. We are starting to see some level of a supply side response in the business, but it's just not at the levels that it needs to be. It takes too long to get those approvals that I talked about. We've had this phenomenon of materially increased construction costs, which impacts the viability of projects for developers. And what we're experiencing then is developers lacking conviction in their feasibilities and therefore not commencing them. And ultimately, if that's going to flush through the system, what we do need to see is revenue response. So prices actually need to go up in order to get this back on track and deal with those embedded cost increases. If I look at our business and what we're seeing, we see some green shoots on this. The better capitalised and well-experienced developers are starting to commence new projects, and I think that's the beginning of the next cycle, but it's early. But we're starting to see those signs now.
So it's good news that we're hearing green shoots. We're all seeing the housing affordability crisis and the human cost of that in the news. But as we were preparing for this podcast, we saw a video that Mark Power, one of your team members, produced where he explained a bit about this residential real estate situation and how his view is it's going to get worse before it gets better. So why is that the view, and where do you think it goes from here?
Firstly, I think Mark Power himself is reflective of the trend in this industry, actually. So Mark is an amazing real estate lender. He runs what we call our income credit strategy for us here at Qualitas. But he's a deeply experienced individual. He spent nearly 30 years in one of the major Australian banks as a real estate lender and then joined our firm some 7 years ago. And so the point of telling you that is I think it shows the way this industry is evolving. People who spent, a whole career, 30 years inside of one of the large banks, leaving that structure and coming into an organisation such as ours. So Mark really is reflective of what you see in the industry. And when he was talking about that and improving affordability and availability of apartments, and saying that it's likely that things need to get worse. I think what he was talking about is what I mentioned before, that in order to get supply to start, prices need to go up because prices need to pay for this inflated construction cost that we're seeing. So by doing that, you'll get the next round of projects to commence. If you track that through, though, and how to ultimately we get some affordability back into the market, I think that comes down to an in-housing mix. The future of housing in Australia has to be medium and high density housing, the same way that it's prevalent in other global cities that are the size of Sydney and Melbourne, 5 million people and beyond. Australia is an outlier in that regard. The historical desire for a detached house is just not a sustainable way for large cities on a go-forward basis. And if you do the analysis and look at the peer set of global cities of that size, but that takes a long time. This is a multi-decade issue for Australia to work through.
So, Mark, when you're assessing that opportunities over the next decade or so, which city do you think is the best apartment market?
Well, we invest across the country, but to say we do predominantly eastern seaboard, and for that is about 50% or so of our population is centred in Sydney, Melbourne and Brisbane. And so it's a great place to invest from a demand perspective and a liquidity perspective. But the thing about real estate is there's cycles within the big cycle. What we're looking for is where is there a shortage of liquidity? 18 months or so ago, there was a shortage of liquidity in the Brisbane apartment market. There were a lot of projects that had strong fundamentals, but there was no supply of capital. And so we selectively worked with a few partners and developers up there in Brisbane and funded a round of projects. That has seen some other people follow into that market. And now currently we're pivoting some attention back to Melbourne because I think Melbourne's been through a very difficult period of time for the last few years, the hangover from the COVID lockdowns and so forth, and a very tough operating environment. And some of those better experienced developers are now starting new projects. But we're looking at that lack of liquidity in Melbourne and the strong fundamentals and investing into that currently.
We've started hearing more and more conversations around private credit. And by the time, Bryce and I are hearing conversations about it, know that it's a hot conversation in investment circles. And you've been, having the private credit conversation for a while. As you mentioned earlier, you were sort of early on the trend after seeing it emerge in overseas markets. So tell us a little bit about how those conversations have changed in Australia and how investor appetite for this asset class has changed over the past 5 or 10 years.
I like to measure this one by the number of invites we get to speak at industry conferences, because previously you would get invited in a Qualitas context to speak at an industry conference and you'll be shoved at the end of day 2 of the conference and not many people would be interested in hearing about this thing called private credit. But you fast forward that now and they want to put you front and centre on day 1 because people are waking up to the way in which this has changed. And the fact it's becoming prominent is something that we welcome. We think it's good for the industry. There are a significant number of new entrants into the asset class and everyone's looking to get a piece of that pie. But I think what that leads to is investors wanting to ask the question of how are you different as a manager to all these other players, and what does it mean for competition, which ultimately leads to the great returns that we think you can get. We are going through some of the inevitable shakeout that happens when you have such a rapid rise in interest rates that we've seen over the last few years. And we're entering that next phase of the cycle where there'll be a separation between the better managers and the not so strong managers. And I mentioned before, there's no free lunch when it comes to risk return, and that applies to private credit as much as it applies to anything else. A higher return carries a higher risk, and I think the transparency of risk is something that investors are now actually becoming aware of and getting used to having to ask questions about. The benefit for us and how we're feeling about it in this environment right now is it's not new to us. As you said, we've been doing it a long time, and what that allowed us to do is get what we think at least is the best-in-class team in the sector. They've got deep borrower relationships, risk management framework, and how we decision the right things to do and the things not to do is strong. It stood up to tests through the cycle. It stood up to challenges within markets, challenges within loans, and has come out the other side showing that we have a very strong track record of not only delivering returns but preserving capital for investors as well. And having done that for 16 years, I think it's testament to the way that we went about it. It is a specialised asset class and it does require a specialist manager to do it. And we think investors need to think about that when they work with a manager and give them their precious capital to invest. But the other question we keep getting is, if we are now on the other side of high interest rates and potentially on the part of the cycle where the Reserve Bank starts cutting rates, what does that mean for private credit and how attractive it may or may not be? And we've observed this before. Typically what happens when the base rate falls is credit margins expand. So what we mean by credit margin is the premium that a borrower pays to us above the risk-free rate. And you can track this over time. As rates start to reduce, those margins expand and you get back to a not dissimilar total return to investors. And so some of the more sophisticated institutions look at that and say, now is really the time to start deploying capital into this space, because you expect to see an increase in the return you get, the risk premium that you get in the environment going forward. But perhaps the more obvious point that does get forgotten about, though, is when rates reduce, it's typically great for real estate values. Typically, they perform better in a lower interest rate environment. Values stabilise, more projects commence, higher opportunity set to invest into. So overall, we think the story is not going to see reducing.
With a growth in an asset class like this comes two things: A, more opportunity for investments and for investors, but also B, more and more people coming into the market to try and take advantage of that growth. So where are you seeing new opportunities that previously weren't available? And then on the flip side, are there any areas now that are just overcrowded and you're wanting to reduce exposure to?
Yeah, excellent question, because I mentioned before around the nature of investors coming into the sector changing. So this was something that was dominated by sophisticated institutions investing in funds managed by the likes of Qualitas. And then it started to go towards retail and high net worth investors, and now ultimately into a listed format for investors. So the ability to give private markets access in a public environment to retail investors, we think, is an incredibly new innovation, albeit it was 6 years ago, well before private credit hit the mainstream headlines, that we identified that and launched the Qualitas Real Estate Income Fund, which is a ASX-listed mortgage REIT, the ticker QRI. And really that vehicle was created to allow the retail and listed investor to invest in private credit. So it's something that's suitable for investors who want that defensive monthly income, but want the ability to access liquidity in a stock exchange listed product. So I think that's a interesting innovation that, while we got to it 6 years ago, has really started to gather and grow over the last few years. If I go to what has this done to benefit the borrowers, who are obviously an important part of this equation, you can have all the capital from investors in the world, but if you don't have an attractive proposition to a borrower, it doesn't get too far. But what they've benefited from is really flexibility in the capital. A good example of this is something that we do a lot of. It's called residual stock loans. So what does that mean? That means when a developer constructs or develops an apartment building, typically they have an amount of apartments left over that are unsold at the end. Historically, the banks would never finance that. So the developer would have all of their equity and profit tied up into completed apartments at the end of the project. Something that private credit has been able to do is monetize that for them, give them a loan against those completed apartments so they can sell them down over time. From a developer's perspective, that's great because they take that capital, then launch their next project, keep the new supply rolling, and ultimately that's something that, as we talked about before, will help address the supply issues that we have in the market. And really that product innovation came from private credit. It wasn't something that banks were doing. If I go to your question about what do we avoid in this environment, and I wouldn't say we necessarily stay away from it, but the smaller end of the market is something that we think has risk in it. So I'm talking about their sub $20 million loan sizes. If you are a new entrant into the market and you're trying to build track record, that's a place they typically play because it's a place where they can make a loan, syndicate it to investors, and it's become, we think, quite crowded in that space given that people are trying to build track record. And we think because it's crowded, there's some mispricing of risk going on in that smaller loan size. So because we're fortunate that we have institutional capital in our funds and large scale in those pools of capital, we've been able to focus our attention on larger loan sizes recently. And thankfully, we're one of the few in the market that can do really big loan sizes. So we're consistently now doing 200 million, 300 million, 500 million and beyond single loan sizes to borrowers. And I think that is a unique capability that we have. So we're trying to steer away from that much smaller loan size where we think there is a bit too much competition.
Well, Mark, it's absolutely fascinating. You said earlier that you measure how hot a sector is by how many conferences you get invited to speak at. Well, if you keep talking about Australian residential real estate and private credit, I have no doubt that you'll be at the top of many invitation lists. But we appreciate you making the time to join us here on Equity Mates and talk through those two asset classes, because it really is a fascinating space.
Great. Thanks for having me. Really enjoyed the conversation. And again, congratulations on all your success with the podcast.
This is general information only and is not intended to provide you with financial advice and has been prepared without taking into account your objectives, financial situation or needs. The Trust Company, RE Services Limited, ABN 45003278831, AFSL 235150, is the responsible entity and issuer of units in the Qualitas Real Estate Income Fund. Prior to making a decision about whether to acquire, hold or dispose of units in the fund, you should consider the product disclosure statement and target market determination for the fund to see if it's right for you. The fund's PDS and TMD is available at qualitas.com.au/QRI.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.